Welcome back, everyone. Michael here with Offshore Citizen. We are here in beautiful Canada, and so I'm walking around exploring some wilderness trails and figured I would film some nice videos for you. Today I want to talk about kind of what I see as sort of the worst case scenario for the economy, and I don't think this is necessarily going to happen. There's a lot of reason from certain macro data to suggest that, almost the opposite could happen. I have a good friend and client who we talk very regularly. He runs a fund, and I'm going to bring him on in the future because they have a lot of macro data, and their data is suggesting something quite different than what it is that I'm going to discuss today. But I do think it's important in a time where a lot of things are down. If we're talking about, say, stocks, 80+% in a bunch of cases. If we're talking about crypto, 90+% in some cases. That we understand kind of where are we at and what could be happening over the future. And so what I'm going to say in this video is really not good, right? It's kind of a worst case scenario. It may happen, it may not happen, but I always think that it's worth being aware of and considering these things. So that's what we're going to discuss today. So let's dive in. Before we do, if you haven't already, please smash the subscribe button, hit the all notification bell. We really appreciate your support. If you like the video, please give it a thumbs up. If you would like help with the things we deal with here in this Offshore Citizen channel, if you don't know, we help you to build the best international strategy, which includes paying the lowest legal amount of tax, figuring out where to set up companies, figuring out where to relocate, what citizenships to get, what banking, etc., as well as helping you with implement that. So, actually getting you the citizenships, actually forming the companies, opening the bank accounts, etc. So you can please reach out to us. You can book a call. Calendly.com/Michael-Rosmer. There's a link in the description below. Or you can send a message to our websites, offshorecitizen.net and offshorecapitalist.com. All right, been walking here for a while. Okay, so what do I see here? I'm going to give some context. I'm going to use the crypto market, but basically the same principle applies to the equity markets, okay? So if you look before, go back to 2017. So in 2017, the Bitcoin price peaked at around $20,000 and then collapsed through 2018 to about $3,000, and then recovered somewhat, had a little run in 2019 up to, I don't remember, $12,000, $14,000, something like that. And I think probably established that about the fair market value at that time, based on the supply and demand, was probably around $6,000. When COVID came, March 2020, we saw the price collapse of all across the board, right? And in that time, the price dropped down to around $4,000 and kind of came up. I made a video back then suggesting that if you bought, I think it was at $7,000, I said, the risk to reward was probably pretty good. Realistically, there was probably a reasonable chance that you'd have 5x in 5 years and probably not that much downside over that time. So turned out it did way better than that. But anyway, that was the deal. Now, we can ask the question of, if the fair market value going into that was around $6,000, and I'm using this as an abstraction, the same principle applies to stocks across the board, which had a downturn in 2018, then did fairly well in 2019. We can look at other cryptocurrencies, things like Ethereum, etc. If we figure that is the case, then the question is, why did the price go up almost tenfold, right? Or over tenfold to a peak of $69,000. And really, the argument would be none of that would have happened, or at least the majority of it wouldn't have happened, if it wasn't for massive central bank and central government stimulus. So we saw obviously lots of stimulus checks paid directly to people, right? Injected a lot of money into kind of the hands of retail people who bought meme coins and meme stocks, etc., but also just flooded the market with money that could go into driving assets pretty much across the board up. And in that scenario, it made sense that the highest risk on assets saw the biggest run up, okay? And so crypto acted essentially as this giant liquidity sink where it just absorbed all this big sponge, right? That just grew. And so now what is the environment? The environment is the Fed is tightening, right? We have basically three things. We have recession, right? So that eats up retail money. So the people who were getting stimulus checks back in 2020, etc., I mean, that money's gone. It's not there anymore. It's not coming back. And on top of this, those people who are doing this are having the inflation eat away their ability to go and invest more. So that's not good. it hurts asset prices. Then, which, by the way, just a quick note, I did a video on this back a number of months ago about how when people were saying, oh, you shouldn't have cash because inflation, I was like, well, actually, inflation drives prices down of assets. So you actually have the wrong view on that, which is kind of a counterintuitive thing that a lot of people don't seem to really understand. Hyperinflation being different than inflation, so that's a whole other side of things. Anyway, so basically, you have that. You have quantitative tightening, which is the government is selling bonds back into the market and basically removing cash. They started this in June in the US, 47 billion a month, going up to 95 billion a month in September. And Canada's been even more aggressive on it. The European Bank has not been doing this. Japan, UK haven't done this. Maybe they will, maybe they won't, we'll see. But you've got this environment. So that's sucking money out. And on top of that, you have rising interest rates, okay? So interest rates have come up quite a bit in percentage terms relative to one another. So in other words, if I go from 0.5% interest rates to 1%, I just rose the interest rates. Even though I went up by 0.5%, I doubled the interest rates, right? And so we could end up at, 3% interest rates, or, some people could argue higher. That's hard to say. Anyway, so these are all things that suck the money out, okay? And you can figure there was 10 trillion or so dollars put into the system over that time. Maybe a little bit more. You'd have to kind of go and do the math, but let's say 10 trillion, pretty reasonably. And so imagine if they suck all of that $10 trillion back out of the market, okay? Which I don't think that they will, but they'll definitely suck a bunch of it out, and they already have sucked a bunch out of it. Well, if that is the case, then you would expect that the prices would return, all things being equal, to their levels pre-COVID. So you would expect that a fair price would be basically 2019 prices. Now, to be fair, we've seen a bunch of companies trading for below 2019 prices, and so that's one thing. But this would bring Bitcoin down to, if you took all the money out, you would argue about $6,000. Now, I think realistically they're not going to pull it all out because, for example, some of the money went in the form of government deficit spending, and that's only going to come out if you have government surpluses. So that money they're not going to do that. There's no way they're running surpluses to any extent here. So that money will remain in there, and probably they will not pull out all the capital that they injected in. So realistically speaking, we're probably going to see some money. So maybe this sets, if you're talking about Bitcoin, at a price of $10,000 to $12,000, somewhere in that range would be kind of a fair number, assuming they pulled out this much money. Okay. Now, so you might say, all right, well, that gives us a base case, so why not buy then? And I did some analysis on this. My theory was essentially to say, look, how do you decide when to buy? And what you might say is you could try and read the technicals and time the bottoms. You could do that. It's very difficult to do, but you could try. You could pay attention to sentiment and try and buy when you feel like it's pretty bottomed out. That, again, difficult to do, but possible. Or you could just buy based on percentages. So you could say, for example, if the price drops 90%, you buy, or if it drops 95%, you buy, and you just figure, as Marco, who was on our channel a couple times, says, low enough for me, right? So it might not be the bottom, but it's low enough for me. And I think there's some wisdom to that sort of outlook. Now, I figured, what is the counter argument to it? Well, the counter argument that people will normally make, which by the way is not, I think, the right counter argument, but their counter argument would be, well, hang on, what if the project or company, etc., turns out not to be big next cycle? Okay, so I think a lot of people are expecting that in 2 years, 4 years, 5 years, you'll have another cycle, you'll have this boom, this is what's happened, therefore it's what's going to happen again. Terrible inductive thinking, not a good way to think about it, but that's the mindset. And that in that environment, you will see projects spike again. But the projects that are winners today may not be winners in the future. And so we can see this with companies really easily. Some of these will go bankrupt, right? But, maybe it's okay. And so what I did was I back-tested. I went and I looked at projects that in 2017 were big and popular and attracted a lot of high valuations, but then they weren't in 2020 and beyond. And what you see is that, for example, IOTA, Bitcoin Cash, Litecoin, Neo, Tron, things like this, if you bought them at a 95% discount, in every single case, you still made 5x your money in the next cycle. In fact, there was only one I could find that was only 5x, I think it was Bitcoin Cash. All the others were at least 10x, okay? And these are projects that, you know, were big back then, but then they were basically dead this cycle. There was nobody doing anything with them, right? At least to any large extent. And so you think, okay, well, this makes for a really good risk to reward. Why don't I just set my limit orders to buy when the prices get down 90, 95%? Now, if you look at something like Ethereum, it never actually went down 95%. It went down, it was peaked at $14.40. It dropped down to $81 at the lowest. So just shy of 95%. But if you bought at a 90% discount at $140, you had over a 30x upside from there. Cardano went down, I think it was 98%, something like that. And, you know, but even if you had bought at 10% decline, it had peaked in 2017 at 105. If you bought at 10 cents, basically, you got a 30x upside. So you can just look and say, well, this is pretty good, right? Like, why don't I do this? Well, here's why you may not want to do that. And here is what I don't hear people talking about too much, but is probably worth considering. So the only analogous periods that I can see in recent history for the insane valuations that we saw in 2021 were, number one, the dot-com bubble. So the dot-com bubble, we saw these just insane valuations, and 1929. Okay, those are really the only two analogous periods for these insane levels of valuation. And what did we see after 2000? Well, if you look at the S&P, actually, if you'd bought at the peak, I think it was June 2020, something like that. Anyway, sometime in 2000. So from there, it went down a lot, but it never actually hit those same levels, even during the housing bubble. So the S&P 500 actually never recovered really higher than it had before in 2007 when it peaked. So it wasn't until, you know, around 2014 or something that you saw prices higher than you'd seen them in 2000. So you basically had a lost decade. You had about 10 years, a little bit more than 10 years actually, that prices were down, okay? And yes, individual assets went up, and yes, you were in a situation where if you bought when it was down, things still went up from there, etc. But you didn't receive that same level of growth back up to the former levels until much, much later. But similar, if you look at 1929. In 1929, what happened is the prices crashed for a few years. It was a terrible, terrible drawdown, and it took, you had over a lost decade to get back to those levels, okay? So let's just consider that this bull market wouldn't have happened without insane central bank and government stimulus, okay? QE infinity putting over $10 trillion into the system. That money flowed into these assets. The question is, if they pull that money out, when are they ever going to do that again? You had this really abnormal event, right, with COVID, like a global lockdown. When has there ever been a global lockdown, right? And so they were trying to deal with that, and it gave them this opportunity to put all this money into there. Realistically, are they going to do that again in the next 2 years, 3 years, 5 years? Probably not, right? It seems unlikely. It's possible, but it seems unlikely. We saw something in Japan similar. The Japanese stock market had peaked in 1990, you know, very long dead period there. So we can just kind of go across and say, this doesn't look so good. And it could be that it takes 10 or more years before prices gradually, incrementally rise to those levels. Now, why is this especially a problem? Because now, if I'm looking out 3 years, right? I'm looking at Litecoin from 2017 to 2020, 2021. It's 3-4 years. Okay, you know, things can kind of still survive, etc. Getting all sorts of mosquitoes here coming after me. It's not so good. They like me, I don't like them. Anyway, so in that scenario, what you could see is that it could be totally different projects, totally different technologies, etc., that are dominant in 10 or 15 years when prices maybe could get back to those levels than they are today. And that seems really, really troublesome for this. So I'm not saying that's going to happen, and I'm not saying that buying when things are low is problematic. You know, it's better to buy when things are low and then they're high. But I think that people comparing to this last cycle's highs are probably making the wrong judgment call. And you should probably be more focused on toning those valuations down a lot. And this is across equities, this is across whatever, to figure out what, very annoying bugs. Anyway, what that is going to be. And Now there is like a bull case that I'm going to give you. Like I said, I'll say about bringing someone on and discussing it and discussing the macro data. And it's a compelling case. So not saying that this can't happen, but I think it's good to also have the worst case so you can make decisions accordingly and maybe not rush into buying assets, comparing the prices that they had, a year ago with what you should expect them to have in the next 2 or 3 years. So let me know what you guys think. Put the comments below. I would love to hear your reasoning more than your specific. I'm always interested in reasons as opposed to opinions. And yeah, thank you very much, and we will see you on the next video.